Hey option traders, for today's trade we are looking at an option play in Dow Jones component McDonald's stock. Following their recent earnings announcement just yesterday, the stock rose 2.7% in pretty strong volume. McDonald's has been consolidating and trading sideways since the start of the year. Shares initially took a dive and hit a low of around 217 in March. Following this drop, volatility contracted and the stock began trading a little tighter. Now shares are above their 50-day and 21-day moving averages. The stock has recently undergone weeks of tight trading, which indicates an unwillingness among institutions to dump their shares. The relative strength line here, which measures a stock's strength relative to the overall market, has also been moving steadily higher since hitting that March low. This tells us that even though the stock has been trading sideways, it's actually been holding up better than most other stocks during this time. So today we are going to look at a relatively low risk strategy known as a broken wing butterfly using put options. This strategy has a healthy profit zone on the downside. Before, we've covered broken wing butterflies using call options, which has a bullish bias, but today we are going to master the trade using put options so we can look for bearish trades with this strategy as well. A broken wing butterfly with put options consists of a few key components. So remember that with options, there are two types of options. There are calls and there are puts. And with both calls and puts, you can either be a buyer or a seller. Just like with any stock, you can either buy long or sell short. The trade is created when an investor sells two puts at a given strike price, then buys one lower strike put and one higher strike put relative to the two short puts. The lower strike put is going to be further away from the short puts than the higher strike put. Each put in this setup will have the same underlying stock, the same expiration date, and a different strike price except for the two short puts, which will have the same strike price. With a broken wing butterfly with put options, you will receive a credit or premium for the trade. These spreads are designed to benefit from decreases in underlying volatility. So, for example, right after a major earnings report or news event with a certain stock, investors can expect to see a drop in volatility, which was heightened leading up to that event. Depending on the option, you could have a number of expiration dates and strike prices to choose from, and this incidentally is one of the strengths of options. Options provide many choices, and investors can analyze a variety of criteria to determine which of these best fit the needs of their portfolio. So, say we assume that XYZ stock will fall to $45 a share by the expiration of your trade. You'd enter a broken wing butterfly with two short puts with a 45 strike while buying a lower strike put and a higher strike put around this point. So maybe you choose a lower strike of 25, 20 points below the short strike, and a higher strike of 50, 5 points above the short strike. The spread nets you a total credit of $1. There are technically two spreads here in this trade. The first is between a long 25 put and short 45 put, and this is known as a credit spread. The second is between a short 45 put and a long 50 put, and this is known as a debit spread. The wider strike credit spread earns the investor a credit to cover the costs of the narrower strike debit spread. This trade can also be done using call options. The trade using put options will make a profit even if the stock price goes down, as long as it does not exceed the credit spread strikes. If it does, the trade will start to lose money. On the upside, the trade has zero risk. You'll earn the biggest profit if the stock moves slightly lower, though, towards the short put strikes. If the stock moves below the credit spread strikes, you will end up with a loss. But the good news is that your risk is defined with this strategy, so you do know your worst case scenario before entering the trade. If the underlying price stays roughly the same while the stock's implied volatility drops, you will still earn a profit. Or if implied volatility drops while time passes and draws closer to expiration. To summarize, broken wing butterflies require time and volatility contraction to make money. So now that you have a better idea of how to set up the broken wing butterfly trade using put options, let's take a look at my trading platform and set up a real-life trade using McDonald's stock. So here we are on my thinkorswim dashboard. So ticker symbol for this one is MCD. If you're on thinkorswim, you're going to select butterfly as your spread type in this box. Make sure you are under the August 19th expiration. And we've got our strike prices down the middle here. And we will be looking at, I would say this row here because the middle strike price is 250, and then we can adjust the higher and lower strike prices down here. And make sure you're on the side of the screen because this is where the prices are for put options. Okay, so to summarize this trade, we are looking to buy one 255 put, sell two 250 puts, and buy one 240 put. So notice that the lower strike put is 10 points away from the middle strike put, and then the higher strike put is only 5 points away. That is what gives you the broken wing butterfly effect. And all of these options have the same expiration date. Assuming a trader believes that McDonald's will move slightly lower or stay in roughly the same place in the coming weeks, they could look to sell two August 19th 250 puts, buy an August 19th 255 put, and buy another August 19th 240 put. Notice that the upper strike put is 5 points away from the middle put, and the lower put is 10 points away. On the downside, the maximum loss can be calculated by taking the width between the first two strikes, or $5, and multiplying by 100. This gives us $500. The maximum gain can also be calculated the same way and gives us the same profit potential. The ideal scenario for the trade is that McDonald's stays flat initially and then slowly drifts lower to close around 250 at the expiration. The total profit zone is between 245 and 255. For risk management, I would set a stop loss of 20% of the capital at risk, or if McDonald's broke below 245. Broken wing butterfly trades are risky and advanced, so while losses are defined, it is still best to practice in a virtual trading account before risking any real money. Only try the trade with real money if you have a good handle on the risks of the strategy. And always remember that options are complex and investors can lose 100% or more of their investment. Be sure to check out investors.com/options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.